Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rambus.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and just before we really jump in, I want to quickly mention our partner, StockOracle.
Right. You can find a 14-day trial link for them right down in the description.
And just a quick affiliate disclosure on that, if you do use our link to sign up, we earn a small commission, which, really helps support the deep dives we do here.
It definitely does. And as always, keeping capital preservation in mind, remember that any AI insights or automated value estimates from any platform, they might be wrong.
Exactly.
You've got to verify the data yourself. We are not giving financial advice here, and we're definitely not telling you to buy or sell anything. We're just, sharing our research thesis.
For sure. So jumping into Rambus, this is one of the most fascinating dislocations I think we've seen in the tech sector lately.
It really is. I mean, if an A-plus student got into Harvard,
Yeah.
right, and the school responded by instantly cutting their scholarship in half, you assume something was deeply, deeply wrong. Like the math just doesn't add up there.
No, it doesn't.
And today, we're looking at a company that is sitting dead center in the AI boom. They just posted record numbers, 20% year-over-year growth.
Right.
They raised their forward guidance, and they beat Wall Street's expectations. And yet, the market responded by just slashing its stock price by, nearly 50% from its peak?
Yeah, a massive drop. And they operate in this highly specialized, extremely profitable corner of the semiconductor industry. But like you pointed out, their fundamental financial reality seems entirely divorced from, how the market is currently valuing them.
Let's lay out this sheer scale that disconnects first, because the numbers in their Q2 2026 report, they are incredibly strong on the surface.
Oh, absolutely.
I mean, they brought in about $207 million in revenue for the quarter.
Yeah, that 20% jump you mentioned.
Exactly. And they beat earnings per share targets.
Yeah.
And they projected even more growth for Q3, guiding for, I think, up to $216 million in revenue.
Right. So by all traditional growth metrics, that is a business executing its strategy flawlessly.
Yeah.
I mean, they are accelerating sequentially and setting higher expectations for the back half of the year.
But then, you look at the stock chart. Since peaking in June at around $174, it is just cratered.
Yeah, down to around $90.
Yeah, near $90. That is a massive 48% discount. So the central question for our wealth building thesis today is pretty simple. How does a company actively powering the AI hardware boom lose half its value?
Right.
Is Wall Street just hallucinating? Or, are they seeing a massive structural flaw that these headline numbers are hiding? Because my focus is always on protecting capital. And a drop like that makes me incredibly cautious.
And it should. To figure out what the market is actively punishing, we have to look past the headline revenue. We really need to understand the mechanics of how Rambus actually generates its cash. Because this is not your standard semiconductor manufacturer.
Right.
They aren't an Intel or a TSMC. They don't pour billions of dollars into building, massive fabrication plants just to stamp out physical chips by the millions.
Wait, hold on. If they are a semiconductor company, but they aren't manufacturing the physical chips, what exactly are they selling to these AI hardware companies?
So they operate on a hybrid model of IP, that's intellectual property and silicon.
Okay.
Their specialty is designing the memory interface controllers and the high-speed interconnects.
Got it.
Think of technologies like DDR5 and high bandwidth memory, or HBM. Rambus basically creates the incredibly complex foundational blueprints that allow heavy-duty AI hardware to actually talk to its own memory systems without bottlenecking.
Okay, so they aren't pouring the concrete or taking the massive construction risk to build the actual data center hardware.
No, not at all.
They just own the copyright to the architectural blueprints. And every time a tech giant wants to build a new AI system that uses that specific memory standard, they basically have to pay Rambus for those plans.
That is the perfect way to visualize it. They license the IP and sell these highly specialized controller chips. And because they are largely selling intellectual property rather than, pushing low-margin commodity hardware out of a factory, their financial profile is fundamentally different from a traditional manufacturer.
I'd imagine so.
Yeah, they boast a gross margin of nearly 80%. I think it was exactly 79.47%.
Almost 80% gross margin in the hardware space.
Yep.
That is usually something you only see in, software as a service companies.
Exactly.
And a net margin sitting around 31%. That is a Very high-quality business from a fundamental standpoint.
And if you look at how that translates to their balance sheet, which I know you love, the advantage of this blueprint model becomes really obvious.
Yeah, I'm looking at the SEC data provided in the research right now.
Mhm.
Because they aren't forced to constantly upgrade expensive manufacturing equipment, they're sitting on over $134 million in cash.
Right.
And there is zero confirmed debt. Zero. Their total liabilities actually shrank from about $165 million down to $140 million quarter over quarter.
Yeah, it's impressive.
When you compare that to their $1.5 billion in total assets, it is an incredibly conservative, insulated balance sheet. That provides a massive margin of safety for long-term wealth building.
It really does. It's a rock-solid foundation.
But, I have to push back here because those numbers are almost too good.
Okay, how so?
Well, with margins nearing 80%, they are practically printing money. But their trailing price-to-earnings ratio, the PE, is still sitting over 45x. And that's even after this massive drop in share price.
Right.
A 45x multiple means investors are still paying a massive premium for future growth.
Yeah.
Doesn't an 80% margin combined with a sky-high valuation just invite massive competition?
Oh, for sure.
Like, what stops Google or Amazon from just looking at the quote-unquote blueprint, reverse engineering it, and bypassing Rambus entirely?
Well, you're highlighting the core vulnerability of any high-margin IP business. High margins attract brilliant competitors. It's just a rule of business.
Right.
To justify a 45x PE ratio, Rambus has to prove that their technical moat is so deep and so complex that even trillion-dollar tech giants would rather just pay the licensing fee than try to invent it themselves.
So how are they actually proving that? What is the specific long-term growth driver, the existing engine, that convinces the market they deserve that premium valuation?
It really comes down to the physical reality of how artificial intelligence actually works. We spend so much time talking about AI chips, the GPUs doing the actual math.
Sure.
But a GPU is just a very fast calculation engine. For AI training and inference to actually work, you have to feed massive terabyte-scale data sets into those GPUs at lightning speed.
Okay.
If the memory can't deliver the data fast enough, that incredibly expensive GPU just sits there idle, waiting for information.
I see. It's like having a Formula One engine but trying to feed it fuel through a tiny coffee straw.
That's a great way to put it.
The engine is basically useless without the flow.
Exactly. The memory bandwidth is the bottleneck for all of modern AI. And Rambus designs the IP that widens that straw.
Right.
Their controllers are integrated directly into next-generation AI accelerators to manage that complex data flow. So as the global build-out of AI data centers continues, the demand for DDR5 and HBM controllers scales directly alongside it.
So the rising tide of AI data centers lifts their boat automatically.
Yes.
But the research also highlights a specific massive win for them recently, right? Something about a major hyperscaler contract for next-generation high-bandwidth memory.
Yeah, that is what we'd call their medium-term catalyst right now. A hyperscaler, just for context, refers to the absolute giants of cloud computing. We're talking companies operating at the scale of Amazon Web Services, Microsoft Azure, or Google Cloud.
The biggest of the big.
Right. Getting a design win with one of these giants is the ultimate market validation. It means the most demanding engineering teams on the planet evaluated the landscape and decided that incorporating Rambus's technology into their custom next-generation AI silicon was the best, most reliable path forward.
And imagine the mechanics of a contract like that go far beyond just a one-time purchase.
Yeah.
Once your blueprint is integrated into a custom cloud architecture, it must be incredibly difficult to remove.
Oh, it creates a multi-year compounding effect.
Right.
When you are designed into a hyperscaler's custom silicon, you are woven into the very fabric of their hardware architecture. Ripping that out and replacing it with a competitor's IP later, that would require redesigning the entire system, retesting it, writing new software to manage it.
Huge headache.
It is prohibitively expensive and time-consuming. So by getting these wins, Rambus secures very sticky multi-year royalty streams.
Which ties perfectly back into their capital efficiency, which is so crucial for compounding shareholder value. The research notes that for the full year 2025, they generated $360 million in operating cash flow.
Yeah.
But their capital expenditure, what they actually had to spend on physical assets, was only about $27 million.
And that right there is the beauty of the model. When that hyperscaler scales up production and builds, say, 10 new data centers using this custom silicon, Rambus doesn't have to build a new factory to service them.
Right, they don't have to pour any more concrete.
Exactly. They just collect the royalties. Every new dollar of revenue drops disproportionately straight to their bottom line.
Okay, so the wealth-building bull case makes total sense. They have software-like margins, the balance sheet is pristine, and they are woven into the custom hardware of the biggest tech companies in the world.
Yep.
So we have to flip the script now and look at what could go wrong.
Let's do it.
Why is the stock flashing bright red across all technical indicators? I mean, a 48% drop from the highs is not just a gentle market rotation or a mild correction. Someone out there is seeing a massive structural threat.
Yeah, they are. And to find that threat, the research points us away from the income statement and directly into the company's warehouse.
Okay.
The Q2 metrics contain some specific figures that are seriously spooking institutional investors.
You're talking about the inventory numbers.
Yes.
At the end of 2025, Rambus was holding about $44 million in inventory, but by the end of Q2 2026, that number surged to nearly $75 million.
That's a big jump.
A $30 million jump in a single quarter for a company that relies mostly on IP. That is massive.
It is a glaring anomaly. And it's compounded by a secondary metric, which indicates that their operating cash flow in Q2 actually fell 35% year over year.
Wow. For anyone listening who looks at their own business or manages a team, a 35% drop in cash flow while your warehouse rapidly fills up with unsold goods, that is a 5-alarm fire.
Yeah, it doesn't look good.
How is management explaining this? Is this a strategic move where they are stockpiling parts ahead of a massive high bandwidth memory rollout for that hyperscaler?
Yeah.
Or, are they building controllers that nobody is buying anymore?
Well, that ambiguity is exactly why the stock is being punished so heavily. In the semiconductor industry, physical inventory is highly radioactive.
Right.
It is not like aging wine, it's like milk. Technology moves so fast that if you overbuild a specific type of memory controller and demand softens for even 6 months, those components can become entirely obsolete.
And if they become obsolete, Rambus has to write down the value of that $75 million in inventory, which would immediately vaporize their profit margins for the quarter.
Precisely. Now, the optimistic view and what management's strong Q3 guidance implies is that this is just a timing issue.
Okay.
They built the inventory to fulfill a massive confirmed order that just hadn't officially shipped by the time the quarter ended.
But if management is so confident that this is just a temporary timing quirk, you would expect the executives to be aggressively buying the stock right now. I mean, if I know my warehouse is full of guaranteed sales and the market suddenly slashes my company's value by half, I am buying every share I can get my hands on.
And that brings us to a highly concerning piece of data regarding sentiment. Despite the massive discount in the share price, there have been 0 open market insider purchases recently.
0.
None. Conversely, insiders have actually sold 25,000 shares.
That feels like a glaring contradiction to the bullish narrative.
Well, to be fair to the nuance of corporate finance, insider selling in the tech sector is incredibly common.
Sure.
Executives have scheduled 10b5-1 plans to sell stock automatically to pay taxes or just diversify their personal portfolios. So a CEO selling shares isn't always a panic button.
Right. People sell for lots of reasons.
Yeah.
But it's the lack of buying that's the
Yeah.
real issue here.
Exactly. The complete absence of any insider stepping in to buy during a nearly 50% drawdown suggests that management isn't viewing this current price as an unmissable generational bargain.
Yeah.
It suggests they view the near-term road as genuinely bumpy.
And looking at the catalyst roadmap in the research, that bumpiness seems tied to a very specific timeline problem.
True.
There appears to be a gap between the tech cycle that is making them money today and the tech cycle that will make them money tomorrow.
Yeah, Wall Street analysts refer to this as the air pocket risk. Rambus's future growth narrative relies heavily on the transition to next-generation server memory modules. This is known as MRDIMM.
Let's break down MRDIMM because this is their emerging engine, right?
Yes.
We established earlier that memory bandwidth is the bottleneck for AI. How does this new module solve that differently than what they are selling today?
So MRDIMM stands for Multiplexed Rank Dual Inline Memory Module.
That's a mouthful.
It is. But without getting bogged down in the electrical engineering of it all, think of standard memory like a single-lane bridge delivering data to the AI processor.
Okay.
MRDIMM essentially acts as a traffic multiplexer. It allows the system to access 2 lanes of memory simultaneously.
Right.
So it effectively doubles the bandwidth and the speed at which the GPU can be fed, and it does this without requiring the data center to entirely redesign their existing server motherboards.
Wow. So it's a massive, necessary upgrade for the next generation of AI training. And Rambus is designing the critical IP to make that multiplexing possible.
Yes.
That sounds incredibly bullish for the long term. What's the problem?
The problem is the calendar. Management has explicitly stated they do not expect revenue from MRDM to be material until 2027.
And in the AI hardware space, waiting until 2027 is an absolute eternity.
Exactly, which creates a fundamental tension for the stock. Remember that 45x PE ratio we discussed?
How'd I forget?
Right. A multiple that high demands constant quarter-over-quarter growth. If the current DDR5 and high bandwidth memory cycle peaks in late 2026, and the MRDM revenue doesn't actually hit the income statement until late 2027, Rambus hits that air pocket. It's a multi-quarter period where revenue flattens out or even dips because the old cycle is fading before the new cycle really begins.
And Wall Street has zero patience for a high multiple stock that suddenly posts flat revenue. So this 48% drop isn't necessarily the market saying Rambus's technology is bad.
No, not at all.
It's the market looking at the $75 million in inventory, looking at the 2027 MRDM timeline, and pricing in a very painful year in between.
That is the most logical interpretation of the bear case, absolutely. But Rambus is actively trying to build a bridge over that air pocket. They have some real optionality here.
Okay.
They aren't just a pure-play memory company anymore. They're diversifying into other critical interconnect technologies, specifically the PCI 7 IP.
Right, PCIe. That is the standard connection interface inside almost every computer, right? Like, it's how the graphics card physically talks to the motherboard.
Exactly. It's basically the central nervous system of the hardware. The industry is currently moving toward Generation 7, which again doubles the bandwidth compared to the previous standard, and Rambus is developing the pre-verified IP blocks for PCI 7.
So instead of a chipmaker spending thousands of engineering hours trying to design a PCIe 7 connection that perfectly complies with the global standard, they just license the blueprint from Rambus and drop it straight into their chip design.
Right. It saves the chipmaker time and vastly reduces the risk of their custom silicon failing to communicate with other components. If Rambus can successfully license this PCI 7 IP across the broader semiconductor ecosystem, it provides a completely separate high-margin revenue stream.
And one that isn't entirely dependent on the memory cycle.
Exactly.
Okay, so we are looking at a classic tug-of-war here. We have a highly lucrative multi-year future pulling against a very murky immediate present.
Yeah.
Let's look at the optimistic outcome first. If we project out, say, 3 to 5 years, and Rambus executes flawlessly on both MRDM and this PCIe 7 standard, what does this business actually look like? What is the blue sky scenario?
Well, just to be clear, this is a highly optimistic scenario, not a guaranteed prediction.
Of course.
But in a true blue sky scenario over the next 3 to 5 years, Rambus solidifies itself as the dominant, inescapable IP franchise for AI memory and interconnects.
Okay.
Financially, that means sustaining 15 to 20% or more in annual revenue growth. By maintaining those 80% gross margins, they would generate massive compounding free cash flow.
The compounding part is what we really care about for wealth building.
Exactly. And those hyperscaler design ones we talked about, they would anchor multi-year royalty streams that are completely isolated from short-term inventory swings.
And historically, this management team knows how to compound value when the cycle is in their favor. I mean, the research notes they have a 31% 5-year annualized return. That is stellar execution over time.
Right. In that blue sky scenario, the market realizes that the 2026 inventory pileup was just a temporary speed bump.
Just a blip.
Yeah, and the stock sees a massive re-rating back up toward its historical multiples.
But, you know, before we can even talk about a 3-year blue sky scenario, they have to survive the storm right in front of them. Which brings us to the near-term catalyst, the upcoming October earnings report for Q3 2026.
Oh, yeah.
This isn't just a standard quarterly update. This feels like an ultimate lie detector test for the entire valuation of the company.
It really is. It is the single data point that will determine the narrative for the next 12 months, easily.
Yeah.
It will either prove that this 48% drop was a once-in-a-generation buying opportunity, or it will prove that the bears were totally prescient in spotting demand destruction early.
For someone analyzing the stock from a capital preservation standpoint, what are the specific metrics they need to isolate in that October report?
There are 2 critical pass-fail metrics. First, top-line execution. They guided for up to $216 million in revenue. If they issued that high guidance while sitting on surging inventory and then failed to hit it, the market will punish them severely.
Because it signals management has lost visibility into their own customer demand.
Exactly.
And the second metric has to be the warehouse.
Yes, that inventory. Does that $75 million inventory figure normalize? Does it shrink back down toward historical levels, which would prove that it was just a smart temporary build-ahead for a hyperscaler contract that successfully shipped?
Right.
Or does it balloon to $90 or $100 million?
Because if they beat the revenue guidance and the inventory shrinks, it instantly defangs the two biggest bear arguments. It proves growth is sustainable and the balance sheet is healthy.
Right.
But if inventory piles up again, it suggests the data center build-out for their specific controllers is genuinely cooling off.
It will be a definitive quarter, no doubt. But, beyond the immediate financial gymnastics of Q3, the Rambus paradox points to a much larger structural question about the future of the entire AI hardware industry.
This goes back to the hyperscalers. We are watching companies like Google, Meta, and Amazon spend billions, literally billions, to design their own custom AI silicon from scratch.
Yeah, they are.
And they're doing this specifically to control their own supply chains and to stop paying massive premiums to off-the-shelf chip makers. They want total vertical integration.
The overarching trend in big tech is definitely bringing everything in-house.
Right. So the role of a pure IP provider like Rambus is sitting at this fascinating crossroads. The bullish argument is that designing a DDR5 or MRDM controller is so incredibly complex and so prone to failure if done incorrectly that even Google's engineering team doesn't want to reinvent that wheel.
Yeah, it is mathematically cheaper and less risky to just pay Rambus their licensing fee. You pay the 80% margin because the cost of your custom chip failing is measured in the billions.
But here is the provocative thought I want to leave our listeners with today. As the sheer scale of the AI boom grows and these data center investments stretch into the hundreds of billions of dollars, does that calculus change?
That's the big question.
If a hyperscaler is spending $50 billion on a custom architecture, paying an 80% margin to an outside IP provider suddenly is like a massive inefficiency. At what point does the drive for total vertical integration force the biggest tech companies in the world to bypass these architectural blueprints entirely and just build their own memory controllers from scratch?
It is the ultimate tension in the semiconductor space. Do you buy the best-in-class component to guarantee performance, or do you build it yourself to capture the margin?
Right.
Up to this point in history, Rambus has successfully proven that their IP is simply too complex and too vital to bypass.
The question is whether that holds true in the era of trillion-dollar AI budgets. For now, the market is staring at Rambus's financials, trying to decide if the inventory spike is a fatal flaw in the model or just a temporary shadow hiding one of the most profitable companies in the sector.
We will find out in October.
We'll see if that Harvard scholarship gets reinstated or if the market decides to revoke the acceptance letter entirely. And that wraps up our deep dive on Rambus today.
Yes, it does.
Once again, if you found this analysis helpful, please like, subscribe, and comment below. And don't forget to check out the 14-day trial link for StockOracle in the description to run your own valuation models. Thanks for tuning in to Smart Wealth with Joshua.